Welcome to part 2 of Business Fundamentals. And in this session, we're going to be dealing with the accounting basics. There are two primary accounting statements that you need to be aware of, and these are the balance sheet and the profit and loss account. The balance sheet shows the state of affairs of the business or a snapshot of the net worth of the business at a point in time. The profit and loss account shows the result of running the business over a period of time. Now, a business is run for profit or loss. So profit or loss is the difference between income and expenses. If your income exceeds expenses, it means that you have made a profit. The opposite is a loss. I also want to introduce you to an accounting equation. The equation is equity equals assets minus liabilities. Now, there are 5 things that you need to be aware of in all of bookkeeping and accounting. And these are assets, liabilities, equity, income, and expenses. Now, assets, liabilities, and equity, these are found on the balance sheet. Income and expenses, they are found in the profit and loss account. Now, assets are resources which are owned or controlled by the business from which the business will derive future economic benefits. For example, if you have sold your goods and you have got people that owe you money, they are an asset to you, they are a resource to you. In the future, you are going to receive that money. If you own a property, you can rent that property out and you can have some rental income coming to you. Or if you are using the property, it means you are avoiding paying rental income. Therefore, you are benefiting by saving on your rentals. Cash is an asset by definition. There are other assets as well. Liabilities are obligations that you have towards other people or other businesses from which in the future you are going to incur some outflows of economic benefits. They are the opposites of assets. Equity is the difference between your assets and liabilities, and as we said, per the accounting equation, that is the net worth of the business. Income, by definition, is what you have earned from your business activities. So what you've charged, what you have invoiced your customers for services or goods offered, that's your income, also called revenue. Expenses are the opposite of income. So this is the expenditure that you have incurred. For example, you pay rent, you pay salaries, different expenses for running the business. Now, assets have what we call a debit balance. Liabilities have a credit balance, and equity normally has a credit balance. Income has a credit balance, and expenses have a debit balance. So normally, if it's a debit balance, if you are debiting an account, you are either recording an asset or you are recording an expense. The opposite is also true. If you are reducing an asset, it means that you'll be crediting that asset. If you are reducing an expense, it means you are crediting that expense. The same applies to liabilities, equity, and income. If you are increasing your liabilities, you are crediting that liability. If you are increasing your equity, you are crediting the equity. If you are increasing income, you are crediting the income account. Now, equity, the primary thing that you find in equity is the share capital that has been contributed when you start the business. Because when you start the business, all you have in terms of assets is the capital contributed. There are no liabilities. So at that time, assets equals equity. So this is an example profit and loss account. So as you see at the top there, it says profit and loss account for the period ended, because we are looking at the results over a period of time. So you have there your revenue, other income, then you've got total income, then you've got a list of expenses there, salaries and wages, rent and rates, other expenses, you've got the total there. So you take your income, which is A, less your expenses, B, you get the profit or loss for the period. So this is an example balance sheet, which is just a list of your assets and liabilities. And notice that it says balance sheet as at, not for the year ended, because we are looking at a point in time. So assets there, property, plant and equipment, trade debtors, cash, giving you your total assets, which is A. You've got liabilities, bank loans, trade creditors. These are the people that you owe, giving you your total liabilities, which is B. The net of the assets and liabilities gives you what is called net assets. In other words, it's also called equity. So equity there, which is your share capital, plus the cumulative profit or loss that you have made since you started the business. So when you add the share capital plus the cumulative profit or loss, or any reserves, also called reserves, you get your total equity, which is D, and D must equal C. So net assets must equal your total equity. If they are not the same, it means that we've got a problem. So it means that the balance sheet is not balancing. That is why it's called a balance sheet. They must balance. It is a rule, it is a principle of accounting. Assets minus liabilities should equal equity at all times. Otherwise, you've made a mistake somewhere. Let's illustrate this with an example. So on 1 January 2018, Joe registers a photography company, Photography Limited, with an initial capital contribution of 600 from his savings and a loan of 400 obtained from ABC Bank. So at this stage, since Joe has not yet started operations, he has no profit or loss. He just has a balance sheet from day one. However, he has some equity and some cash in the bank. His balance sheet therefore looks like the one on the screen. So balance sheet as at 1 January 2018, cash 1,000, obviously made of the 600 from his savings and the 400 which he has borrowed from ABC Bank. So on the liabilities, we've got the 400 which he owes, he has to return to ABC Bank, so giving us his net assets or net worth of 600, because that is what is truly his, because the 400 in his bank account, he has to pay it back. And notice that that also equals to the equity. The share capital is what he has contributed himself, which is 600, and it equals to the net assets. So our balance sheet is balancing. During 2018, Photography Limited billed 7,500 to its clients, of which 500 remains to be collected from the clients. In doing this, it incurred the following expenses: rent, salaries, consumables, rates. At the end of the year, all expenses have been paid by cash except for 100 of the rent, which will be paid in January 2019. During the year, Joe also managed to pay back 200 of the loan obtained from ABC Bank. So what you're seeing on the screen is an example profit and loss account for the period or for the year ended 31 December 2018. So we've got our revenue or income there of 7,500, and then we've got expenses of salaries and wages 2,400 per above, rent and rates, which is made up of the 200 for rent and the rent for 600 per above, consumables 650 per above. Total expenses 3,850. Therefore, the profit for the year, which is A minus B, income minus expenses, 3,650. What you're seeing on the screen is what the balance sheet looks like. So it is the same facts as we were dealing with for the profit and loss account, but this is the balance sheet. So we've got trade debtors of 500, which is what remains to be collected from our clients. Then cash, you see that we started with 1,000, then we earned 7,000, which we received from our customers. And then we paid some expenses there. We also paid 200 to ABC Bank. So what is remaining in the account is 4,050. So our total assets, which is 500 from 4 plus 4,050, give us 4,550. Liabilities, see that our bank loan has now gone down from 400 to 200 because we paid back 200. our trade creditors, which is 100, which remains to be paid, which is the rent which we're going to pay in January 2019. So our total liabilities is 300. So our net assets or our net worth is 4,250, which is the difference between our total assets of 4,550 and our total liabilities of 300. Equity, we started with share capital of 600, and during the period we made a profit of 3,650. So cumulatively our profit is 3,650. Those are our reserves plus our capital, gives us our total equity of 4,250. Notice that the balance sheet is balancing because our net assets equal our equity.